So the first thing I wanted to talk about was the recent rise in interest rates. This is important going forwards because interest rates determine the cost of money, which then impact the ability to borrow, which then impact economic activity. Recently, bond rates have started to rise because there's an expectation that spending will increase and that will push up inflation and that will ultimately push up interest rates. Initially in the cycle, that's positive for markets, but eventually, once interest rates become too high, it can have quite a severe impact. So this is something that we're watching very closely. The second thing that I wanted to talk about was that there's a historic precedent that after tough times, like we went through last year, like after World War I, after World War II, there's a release of economic pressure and personal pressure. And so during the hard times, people built up their savings, and then there's a rush of spending, which they dub revenge spending. So this revenge spending is expected to flow through the economy and be positive for markets. So all up, what we're saying is in the short term, we think the environment for markets is positive. We've got rising interest rates, which in the short term are positive, but in the long term could be a problem that we're watching. We have increased spending, which is great in the short term, but that's a cyclical thing. The spending will move through the economy. The bubble of savings will be spent. And so again, we're looking towards the longer term to see what happens in the longer term. But also there's a lot of positive news on the vaccine front and the opening up of economies. And so our expectation is reasonably positive environment in the short term, but we're watching with some concerns for the long term.